So shall we go back to the Plastin case? If you could please pull out your notes from chapter 5. Again, we're going to revisit Plastin. I'll quickly review everything that happened until this point, and then we'll take it from there. We'll see how to refine the costing system. We'll introduce activity-based costing. So last class, we reviewed everything that we studied in job costing. Now, in job costing, we worked on a few cases. We worked on the Robinson Company case, and then we worked on the Anderson construction example, the exercise from your textbook, right? And we characterized all of those costing setups as being simple or traditional costing setups. Okay? Now, the only thing that distinguishes a simple costing setup is the way in which you allocate your overhead. And so if you remember, if you think back to the Robinson Company example, and also to the Anderson construction exercise that we worked on last class, had very simple ways of dealing with overhead costs. We had a long, heterogeneous sort of basket, sort of kitchen sink list of all the different overheads that we incurred in the enterprise. Could include things like salaries, repair and maintenance, rent, electricity, utilities, managers, benefits, etc. We grouped all of them together into a single cost pool, and we allocated them using a common allocation base. So the assumption that you make in those very simple costing systems is that each of the cost objects that you are trying to cost uses up the same proportion of each of your overheads. Okay, that assumption sometimes tends to be too simple or too simplistic when you have a wide range of products which are very different from each other, so each of those products might be using up a very unique or distinctive combination of your overhead resources. So when you have a costing system that's overly simple or overly simplistic and doesn't account for this kind of complexity, what can you end up having? You end up having what we describe as product overcosting and product undercosting. Okay? So can anyone describe to us in their own words what overcosting and undercosting refer to? What is going on when a product is overcosted? What is going on when a product is undercosted? In your own words. Yes, Harvinder. Okay. Yes, that's precisely right. So those are the consequences of overcosting and undercosting. That's what happens when you have overcosting. That's what ends up happening when you have overcosting and undercosting. The question is, what is overcosting or undercosting itself? Can you describe it in words? What's happening? What is going on under the scenes when you describe a product as being over or undercosted? Okay. So you assign costs to a product that are too high relative to the value of the overhead resources that the product has actually been consuming. Right? That's a way to describe overcosting and undercosting. And just to clarify, we don't think about costs as fixed or variable. We think about costs as direct or indirect in our costing exercises. Okay. So overcosting arises when you assign a larger share of overhead costs to a product than it truly consumes, or you cost a product at an amount higher than the true value of the resources that it's consuming, or your best estimate of the true value of the resources the product is consuming. The reverse is happening when you undercost something. The product might actually be consuming a higher value of resources, but you assign to it a cost that's lower than that. Okay? Now, overcosting and undercosting naturally have economic consequences that we heard someone describe to us. When you overcost, you end up setting the price too high, and sometimes you drive away your customer. Similarly, when you undercost, you end up setting the price too low. This scenario, you don't drive away your customers, but the opposite happens. You gain market share, but you end up gaining what could be unprofitable market share for you to have, or market share that you shouldn't have really in the first place if you were setting an equilibrium price. Okay? What makes over and undercosting so dangerous is the fact that it never strikes just one product at a time. It's always striking more than one, so at least two products. If you have just two products and you identify that one of them is overcosted or undercosted, that means the other one is also inaccurately costed, except in the opposite direction. So when you have one product that's being costed too high and another one that's being costed too low, really what's going on is cross-subsidization. The product that's being overcosted is subsidizing the product that's being undercosted. Okay? So we started out looking at the Plastron case, which is the case from your textbook. Your entire activity-based costing chapter follows this case. Okay, so that's why it's illustrative for us to get into it. Plastron is a firm that made, I think, lenses. Okay, it had two types of lenses, a simple lens and a complex lens. They made 60,000 of the simple lenses last year and 15,000 of the complex lenses last year. So the simple lens market is about 4 times larger than the complex lens market. These information about direct materials and direct costs were all given to us. These are total data and these are per unit data. Okay? And the overhead allocated figures alone we came up with on our own, right? So someone remind us how we allocated the overhead, how the overhead is being allocated under the current system that's described on the board. How did we allocate the overhead to come up with this split? We allocated using direct labor hours. We had a very simple costing system. We aggregated all our overhead into one single cost pool. We picked one allocation base, which was direct labor hours, and we split the overhead up by direct labor hours. Now, so the total overheads were somewhere in the region of $2.4 million, right? 2.385, I think, to be precise. And the total direct labor hours that we had was 39,750. Which was split up between the simple lens and the complex lens in a roughly 3:1 ratio. Remember this? So we had 2.385 million being spread out across 39,750 hours, out of which 30,000 hours were consumed by the simple lenses, and that's how we came up with this number. And we did the reverse for the complex lenses. 9,750 hours were used up by the complex lenses, and that's how we came up with this number. You know, you were told that the complex lens is more difficult to make than the simple lens. So intuitively, this should tell you that the complex lenses are going to be consuming more overhead resources per unit than the simple lenses. But that's exactly what you do end up seeing here. The overhead allocated to each complex lens is $39, which is $9 more than the overhead allocated to each simple lens. So overall, the system seems to be giving us results that are consistent with intuition. So there's nothing sort of obvious, there's no obvious red flags that are going off right now. So a total cost estimate for each simple lens is about $60. Total cost estimate for each complex lens is about $100. And then we intersected this with another piece of given information about the price at which we are currently selling the simple lens and the complex lens. And presumably our price is based on our costing information. We're building a certain margin into our estimated cost to come up with our price. So each simple lens goes for 63, each complex lens goes for 137. That gives us the following estimates of the profit margin. So each simple lens gives us a profit of $4.25. Each complex lens gives us a $40 profit. Okay? So now the exercise we wanted to do is to compare the profitability of the simple lens to the complex lens. So I'm going to repeat a question that I asked last class. I wanted to compare the profitability of the simple lens to the complex lens. What prevents me from simply comparing the $4 to the $40? I want to compare the profitability of the simple lens to the profitability of the complex lens. What prevents me from simply comparing the 425 to the 40? Yes, what is that? That's precisely it, right? You see here that that each complex lens requires about 40% more resources than does each simple lens, right? So even holding the dollar for dollar profitability the same, you would expect each complex lens naturally to give you more of a profit than each simple lens. So really what you have to ask yourself is not just, is this number larger than this number? No, that doesn't give you much information. Is this number proportionately larger than this number to compensate you for the extra resources that you put into each complex, within each simple lens? Okay, so just a small note here. This is something that's related more to financial than to managerial accounting, but something that's useful for you to know. The word profit and the word profitability means two completely different things. Okay, the word profit refers to this. This is the profit, typically expressed in dollars, that you make from each simple or each complex lens. But the word profitability is a scaled concept. It usually refers to something like, for every dollar of investment that you make in a particular project, how many cents is it returning? So profitability is always a scaled concept. It's always usually expressed as a percentage. It's your profit on top scaled by something in the denominator. And that something could be the cost per unit, it could be the revenue per unit, it could be the amount of assets that are invested per unit, and so on. But profitability is always a scaled concept, always expressed as percentages. Okay, so in this case, you can calculate the profit margin percentage or the profitability in many different ways. There are hundreds of different ways to calculate the profitability, but in this case, we're going to use a very simple definition. Take the profit margin and scale it by the revenue, the selling price that you get per unit. So these percentages can be interpreted as the following. For every dollar of revenue that you get from a simple lens, you get to keep 6.7 cents as profit. For every dollar of revenue that you get from a complex lens, you get to keep a whole 30 cents as profit. Okay, so this is a measure of profitability, whereas this is just a measure of profit. So let's put that down. Okay, and anytime you want to compare two or more products that are dissimilar to each other, that are not identical to each other, you must have a measure of profitability. You cannot simply compare the profits, because the profits are absolute numbers and are influenced by the size of the product, the scale of the product, and by the original investment that you put into the product. Okay, so once you calculated this is a complete income statement, by the way. Right? This is at least the first half of an income statement, because we have revenues here, and then we have built up our total estimate of cost, and we come up with some measure of gross margin. Okay, so now we're able to form a picture in our heads of each of these two products, right? And we wrote down a number of things about each product. So the simple lens, to begin with, seems like more of a high volume product, right? Naturally, because you sell about 4 times as many simple lenses as you do complex lenses. So the complex lens is a relatively low volume product, but what is compensating for the low volume of the complex lens? The high rate of profitability, right? So even though the absolute dollar revenues that you make from the complex lenses is relatively small, for every dollar of those revenues you get a lot of profit, whereas the opposite is true for the simple lenses. So this is low volume, somewhat high margin, and this is high volume, somewhat low margin. Naturally, since this is a low margin product, it seems as though this is a very competitive pricing strategy, right? Because our total costs are almost $60, but we're only pricing at something slightly above $60. Okay, so it seems like this is a very competitive pricing strategy. Looking at the internal data, of course. And what else is consistent with the fact that we use a competitive pricing strategy here? The fact that this is a simple lens, right? So the fact that it's a simple lens tells you it's probably a product with standard features. If it's a product with standard features, there is also likely to be what? There's likely to be competition from other people that are making the same product, right? And so given that there are substitutable products available in the market, you really have no choice except to price at a relatively low margin, whereas the complex lens looks very different, right? We're able to get away with a relatively premium price. So it could be that this is some kind of special product that only we know how to make. Okay? So this is all the data that we put up, and then we talked about some surprising developments at Plaster. So someone summarized to us the surprising developments and why it is that they were surprising. Mm-hmm. 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 That's precisely right. Except that they were not explicitly comparing the price of the simple lens to the complex lens. They were primarily complaining about the price of the simple lens, and then they were also like, oh, by the way, this is the very good price. Right? So the two are not related, but those are definitely the two feedbacks that we got from our customer, that the simple lens is priced too high, but at the same time, the complex lens seems to be reasonably priced. Now, why is that development surprising? On the simple lens, right? So from internal data, our description or characterization of our strategy was that this is a very competitive price for the simple lens and able to get away with charging a little bit of a premium for the complex lens. So the feedback from the customer is exactly the opposite of our own description or characterization of our strategy. Now, whenever that happens, that's a problem, right? Because it means that whatever it is that you're visualizing in your mind, you're not able to implement and get it done the way in which you expect, right? So what could be consistent with this surprising development? What is a possible explanation that fits all these facts? We described two possible explanations. I want to hear both of them.
One of them is that the trust and costing is incorrect.
Mm-hmm. Specifically?
Cost incorrectly for certain products.
Yes, so specifically, what's the inaccuracy in the costing? If it were a costing explanation. So which of the two do you think is overcosted and which of the two is undercosted? Just given the fact. This is a lens that the customer is complaining is priced too high. That might potentially be overcosted, and this is the one that the customer was telling you is quite reasonably priced. So it could be that this is being it's being undercosted, and that's why we're ending up charging a lower price, a price that's so low that even the customer is surprised by it. Okay, so you see why the simple lens could potentially be overcosted and the complex lens could potentially be undercosted. So that's a cost accounting explanation. You wouldn't necessarily come up with that explanation if you didn't know anything about cost accounting or about cost allocation, right? Or about how these costs were actually built up. Now, there is a non-accounting explanation that's also perfectly consistent with these facts. So let's hear it.
Well, it could potentially be the external editors may either be much better at making the lens.
At making which lens?
At making the simple lens.
That's right.
They could have different sources and are getting materials for
cheaper, yeah.
Cheaper, they may be buying much more different possibilities that
or the converse, we might not be doing one of those things correctly, right? It could just be a real explanation. By real, I mean not accounting explanation, which just relates to the fact that your competitors are better than you at making this product, either because they are doing something well or because you are doing something badly, right? It could be that we don't generate sufficient economies of scale, or our production process is not aligned efficiently enough, or it could be that they do one of those things better. So that's a very kind of real non-accounting explanation. So in the real world, it's always a challenge to distinguish between these two explanations, particularly because it's very difficult to affirmatively identify that there's a problem with the costing system. Because as far as your internal cost data go, this is the best that you can do at this point. Okay? You don't have an affirmative indication of the fact that yes, this product is overcosted or that product is undercosted, because there are no golden benchmarks to compare these costs against. So really the best that you can do is first go to the internal costing data and try to see if you can refine the costing system a little bit. Okay, and then look at the cost numbers that come out of the refined costing system and see if that changes your perspective on any of these problems. Okay, so first we're going to go to the costing system. We're going to study a way of improving or refining the costing system and see how that changes our perspective on the problem. If it does change our perspective on the problem, well and good, we follow the revised plan of action. If we go and try to refine the costing system and we find that the refined costing system doesn't give us substantially different numbers from what we have here, then we go to the real explanation or the non-accounting explanation, which could just be that, okay, the other guys are just able to do something better than we are. Okay, so you first have to make sure that you have the best possible information, and then you make decisions based on information. So we're going to try and improve the simple costing system that we have here. Now, there are very many ways of improving or refining a costing system, but there's one sort of standard way that's become very popular over the last 10, 20 years, and it's called activity-based costing. You know, activity-based costing was invented by a couple of professors from Harvard Business School, okay, and they made a very profitable business out of developing the concept. And within a few years, all the big consulting firms, all the big accounting firms, McKinsey, Bates, all of them had developed these big sort of teams that specialized in implementing activity-based costing. So they would go in to factories, they would go into different government departments, they would study their current cost allocation systems, and they would put in place an ABC system. And like with most of these things, ABC was a very popular sort of buzzword. In the 80s and the 90s, everybody wanted to do it. Many departments of the US government implemented activity-based costing, which is remarkable considering how little government departments change over time, usually. And now sort of the ABC trend has sort of died down, but it's still sort of the classic way to refine a costing system. And actually in the last couple of years, people have started talking about ABC again, because what tends to happen during a recession, usually? During a recession, everybody starts becoming more conscious about costs, right? In a boom economy, everyone's focusing not on costs but on revenues, because revenues are growing, right? But in a bust economy or an economy that's not growing, your revenues are somewhat stagnant. They're not moving up considerably. So if you want to increase your profitability, what do? You have to bring your costs down. Right? So the focus kind of shifts between growing and declining economy, so everyone's talking about ABC again. So luckily for us, ABC is very simple, very intuitive. Okay? The very first step in an ABC implementation is to go to your production process from beginning to end, okay? And to study it in terms of all the different activities that contribute towards the final creation and shipping of the product. So you will have a team of ABC experts that goes in and looks at the entire manufacturing process from end to end and divides the process up into many hundreds of small irreducible activities, that each of which contributes towards the final production of whatever it is that you're making. Now, a typical activity, an activity simply means the English definition, any particular task or event that has a role in the production process, that contributes one more step towards getting the product made. So a typical activity list will be hundreds of pages long, because most manufacturing is relatively sophisticated and complex, right? But we are going to use the classic example here, a very sort of simplified, simple activity list. So if you were to look at page 5 of your notes. If you were to look at page 5 of your notes, you're given the sort of very basic, very simplified activity list that the people at Plastum have come up with to describe the process of production and shipping of the lenses. So the first thing in the activity list is to design the products and processes. Now keep in mind again, this is a very simplified activity list. So a realistic version of this would have this activity split up into tens or hundreds of other activities, right? And each of those might be things like, okay, come up with engineering drawings for part number 1, and then design the prototype for part number 1, test part number 1 500 times, go back and redesign the prototype for part number 1, test it again another 1,000 times. So each of these what we call an activity is in fact made up of hundreds of smaller activities in a realistic activity list. Okay, so this is a very simplified one. Now the second sort of major activity that they come up with is to set up the molding machine. So that manufacturing can start. Now, what do you imagine this consists of? What do you imagine this consists of? Once you've come up with a design, well, naturally you can't just turn your assembly line on and start spitting out the final product. Okay? There's a sort of a setup process that has to happen every time you're ready to have a production run. And typically production runs are done in batches. If you have a product, you would have a certain batch size, or maybe 500 to a batch, and you make that product 500 at a time. So that's what we call a batch. And typically every time before you start a batch, there's a number of activities that you need to do in order to get that process started. The first of all might be to calibrate all your production software, give it the right starting values. Then you might have to do a test of all your machines and make sure that everything is set up and is aligned properly. And then you might have to do a couple of dry runs, a couple of trial runs to make sure that everything is working as it should. And only then can you actually start the operating process. Okay, so all of those activities are what they describe here as setup activities. And then operate the molding machine to make the lenses. So this is the process by which you actually run the assembly lines and you spit out the finished batches. And then clean and maintain the mold after the batch is done. After the batches are done, prepare batches of finished lenses for shipment. Okay? What do you imagine this involves? Typically it's going to be things like identifying an optimal size in which to box your product, putting it into the right kind of packaging, and then taking it to whatever warehouse or whatever transportation center that it's going to wait at until the point at which it can actually be shipped. The sixth activity is to distribute the lenses, and it's again composed of many other activities, right? There's going to be transportation, there's going to be sorting, there's going to be receiving at the other end, unpacking, display, lots of independent activities there. And then finally, administer and manage all the processes. So this is your administration, your paperwork, your accounting, your support, all of that stuff. It's sort of an overall and overarching support activity for all of these other activities. Okay, so the very first sort of step 0 in an ABC process is to come up with this activity list. Now, using this activity list, we're going to go back to our costing system and we're going to refine it. Okay? So there are 3 basic steps that you're going to do. The first step is use the activity list, okay, to see if there are any costs that are currently included in your indirect cost pool that you can actually break down to a point where it can be traced directly to either the simple lens or the complex lens. Okay? So the very first thing we're going to try and do is to try to take this pool of indirect costs and try to shrink it or reduce it as much as possible. Okay? So in the Plaston case, they realized that cost number 4, okay, and that's the cost of cleaning and maintaining the molds after the lenses are made, consists largely of salaries paid to workers who are responsible for cleaning the molds. These costs can be traced directly back to the specific mold that can be used to produce the lens, and therefore can be traced back directly to either the simple lens or the complex lens. So the very first thing that we're going to do is to so this is the overhead cost pool that we're starting out with. So we're going to take one component of that cost pool, which is the cleaning and maintaining costs, and we're going to reclassify that as a direct cost. Okay, and are you told what the cleaning and maintenance costs are? No, but we'll get that information later. Okay, so the very first thing you do is you use this activity list to see if there are any costs that you can associate relatively directly to either the simple or the complex ones. If the answer is yes, you just move it out of the pool of indirect costs altogether. So you try to make this pool as small as you can to begin with. Okay, now suppose you've already done that and that's the only one that you were able to separate and take out. The second step is the most important step. You find a way to take this one large heterogeneous cost pool. Okay, and what do I mean by heterogeneous? What does that mean? Made up of very many different types of things. That's what heterogeneous means in general, right? So you find a way to take this relatively heterogeneous cost pool and to split it up into a number of smaller but more homogeneous cost pools. And how we're going to do that is based on the activity list. Okay, so now we have here a very particular way of looking at our overall production process, which is split up by activity. So we have 1, 2, 3, 4, 5, 6 different activities. So we're going to take these overheads and we're going to reclassify them into 6 different cost pools based on the activity. So design cost is going to be one cost pool. Setup cost is going to be another one. Operating cost is going to be the third one. Shipping costs, distribution costs, and administration costs. Now there's something very important to note here, okay, which is a shift in the way in which we look at our costs. So what kinds of overheads do you imagine are sitting inside this original cost pool? Can you name the different types of costs that are going to be sitting inside there? Now my question is, can you give examples of the kinds of indirect costs that are likely to be included in this overhead cost pool? Give me some examples. Yes. So any kind of indirect salaries, like maybe supervisor salaries, manager salaries. What else? Rent, costs that are similar to rent, like utilities, electricity, maybe repair and maintenance, and so on. So this is the way in which we are used to thinking about costs by their nature or by their type or by the kind of resource it's being paid for, right? So salaries is a payment for somebody's time, rent is a payment for usage of space, utilities, electricity is a payment for usage of electricity supplied by the government, repair and maintenance, again, the payment for somebody's time, and so on. So we're used to thinking about these costs split up by the type of resource that's being paid for. But in activity-based costing, you regroup or realign these costs in a completely different way based on the kind of activities they are associated with. So here, what you will do is, you will take your salaries and then you break it down by the activity that each of those salaries is associated with. So the salaries of your design engineers, rent on your design facility, and then electricity, utilities, any repair and maintenance on your design prototyping equipment, all of those costs are going to be taken, are going to be realigned into one single cost pool that you name your design costs. So now keep in mind, we're not looking at costs by their nature anymore, but we are regrouping all the costs based on the kind of activity that those costs associate with or align to. So similarly, your setup costs will contain things like salaries paid to your setup engineers, or salaries paid to the engineers that are monitoring the setup equipment, and also any depreciation, maintenance on the machines that you need to calibrate during setup, and so on. Shipping costs will include the salaries of your warehouse supervisors, of your trucking supervisors, gasoline on your on your transportation method, packaging, receiving, all of that. So we're going to take these costs and we're going to realign them, regroup them based on the activity that they associate with. Okay, so it's a very specific, very particular way of looking at costs that's different from the way in which we've looked at them before. This is clear? Okay, and then we do one last thing. So now that we have these 6 indirect cost pools, which we call our activity-based cost pools, what do we need for each of these 6 indirect cost pools? We need an allocation base. We still need a way to allocate each of these indirect cost pools. Right? We're not going to go to all the trouble of reorganizing our costs into all these cost pools, simply to go back to our old allocation base and use that, because that would be besides the point. Right? So now we need an allocation base for each of these cost pools. And how do you come up with an allocation base? It turns out to be relatively easy, because each of these pools is designed around a particular kind of activity. So you find a way to measure that activity and you're done. Your measure of that activity is going to be your allocation base. Okay? So what would be a good way to measure the design activity? That's a relatively hard one. What would be a good way to measure your shipping activity? If you say that a shipping department has done twice as much work this month as it did last month, what kind of activity do you have in your mind when you say that? Yes. Yeah, so the number of parts that you ship or the number of independent boxes that you ship is sort of a natural measure of the shipping activity, right? So that's probably some. So we come up with a measure, with a way to measure each of the activities that we reference, and that becomes your allocation base for allocating those costs. So for the shipping cost, it could be something like the number of parts that were shipped or the number of separate boxes that were shipped, or maybe the number of cubic feet that were shipped, and each of the boxes is of a different size. The distribution costs could be something like the number of miles driven, because again that's a natural measure of the distribution activity, because distribution is all about getting something from one place to another place. With your operating cost, this is refers to the activity of actually running the assembly line. So maybe an ideal measure of that activity would simply be how many products did you produce out of the assembly line, right? How about your setup costs? What would be a good measure of your setup activity? Remember, a setup has to be done every time you initiate a new batch of production. Right? So what would be a good measure of your setup activity? The number of batches that you were to produce, right? Actually, I have an example for you from the textbook, which relates to the setup activity. So let's look at that. Okay, so you have the simple lenses and you have the complex lenses, and you know that you make 60,000 simple lenses and 15,000 complex lenses, right? Suppose you make the simple lenses in batches of 240 each. Okay, so each batch of lenses contains 240. But suppose you make the complex lenses in batches of only 50 each. Now, why do you think this difference? Because this is more specialized. So naturally, it might become unwieldy to handle too many at the same time. Okay? So given that this is the case, how many batches are made of each? Tell me how many batches you make of each, simple and complex. 250 batches of the simple lens, and this is what? 300 batches of the complex lens. So one natural measure of the setup activity could simply be the number of batches, right? Because that kind of measures how much, because if your main setup cost is, let's say, the salaries of your setup engineers, naturally, the more batches are allocated towards one particular type of lens, the more of the time of that resource is being spent on that lens. So it becomes a natural metric. But suppose I give you some additional information now. Everyone can see this? So suppose I give you that additional information, and that is the number of setup hours that you need to do each batch. Okay, so what does that mean? So that means to set up each batch of the simple lens, the engineers need to spend 2 hours tuning and fine-tuning and trialing and all of that. Whereas to set up each batch of a complex lens, the setup engineers need to spend 5 hours doing that. Okay, so now, could you use this information to come up with a more refined way of measuring the setup activity? So previously we agreed that the number of setups, the number of batches to set up would be a good measure of the setup activity. But now I'm giving you an additional piece of information that suggests to you that one batch of a complex lens is actually more work than each batch of the simple lens. Okay. So could you use this new information to come up with a better way of measuring the setup activity? How many batches produced per hour? No, what this means is to set up each one of these 250 batches takes 2 hours of time. To set up each one of these 300 batches takes 5 hours of time. Okay. That's correct. So the total number of setup hours, right, so the simple lens would be 500. Right, so the complex lens would be 1500 hours. So now when you look at this, you realize you get a true kind of understanding of exactly how that setup resource has been split up between the simple lens and the complex lens. Right, the main cost here is the salaries of the setup engineers. The setup engineers are spending what proportion of their time on the simple lenses? Only 25%, right? 1500 out of 2000. They're spending 75% on the complex lenses. So this could be the best way of measuring the activity. So this is how you go about the process of identifying your activities or your allocation basis. You ask yourself, what is the activity that's being paid for here by this cost? And you look at all the different ways you have of measuring that activity, and you try to combine them to come up with the most informative measure possible. Okay? So the people at Platinum have done all of this. Okay, they've come up with the 6 indirect cost pools, and they've come up with a specific activity that they're going to use to allocate the costs of each cost pool. And they've also split away a certain portion of the cleaning and maintenance costs and reallocated them as direct costs. So let's lay out all of that information. It's all given to you here, and let's see how to recalculate. So we look at the top of page 7. You're given a chart with lots of extra information. So let's go through that chart. So based on all of this analysis, Platinum compiles the following data. Okay, so they come up with their indirect cost pools, 6 in number, which are activity-based: design, setup, operating, shipping, distribution, and administration. They also come up with the costs that have been allocated to each pool. So they take all of these costs from here, they regroup them and realign them the way that we discussed, and they figure out how much costs are associated with each pool. So design costs, pretty large, 450,000. Setup costs, 300,000. The operating costs are naturally the largest, right? Because you need very many hours in order to produce so many lenses. Shipping costs 81,000, distribution costs 391, and admin costs 255,000. Now they come up with the allocation base, so the activity that they're going to use for each of those. Let's discuss each of those allocation bases one by one. So the design costs they are going to allocate using parts square feet. What do you think this means? What do you think parts square feet means? It's just like setup hours or man hours. I'm guessing it's the number of parts multiplied by the size of each part, right? So naturally, the more parts go into some particular lens, the more time your design engineers spend on that particular lens, right? And the larger each part is, probably the more complex it is. So suppose the simple lens requires only 2 parts to be designed, and each of those parts are 10 square feet each. The total number of parts square feet for the simple lens is going to be 20. But if the complex lens is 10 parts, and each of those parts is 20 square feet each, then the total parts square feet for the complex lens is going to be 10 times 20 or 200. Okay, so this is just like setup hours or man hours, parts square feet, the number of parts multiplied by the size of each part. Okay. Question? Please. Parts square feet, not parts per square feet. Yes. So it's not parts per square feet, but parts hyphen square feet. Okay. So suppose you had 5 parts. Okay. 3 of them were 10 square feet each, and the other 2 were 1 square feet each in size. So your total parts square feet is going to be 10 plus 10 plus 10 plus 1 plus 1 is going to be 32. Okay, so it's just a measure not only of how many parts go in, but also size of each part, which is probably a crude measure of the complexity of each part. Ideally, you want to have a better measure of the complexity, but maybe practically this is the best way in which you can measure it. Okay. Your operating costs are being allocated using molding machine hours. Now this is simple, right? This is just the number of hours for which you ran your molding machines. Distribution costs, shipping costs using the number of shipments made. We talked about this. Distribution costs using the number of cubic feet that were delivered, so volume. Okay. Administration costs. Okay. Now, what is a good allocation base? What is a good way to measure the administration activity? What is administration? What do you mean by administration? What do you think administration involves? Yeah. Actually, administering the labor would be one. So administration is things like accounting, payroll, making sure all your bills get paid on time, answering the phone, making appointments for your managers, that sort of thing. It's a very difficult thing to measure with a number. And the reason is because your administration activity doesn't scale up or down predictably with any measure of factory output. It might be that your factory produced twice the output in September as it did in August, but are your administrators working twice as much? Perhaps not really. Okay, so administration doesn't really scale up or down predictably with any measure of output. So you simply have to use some rough measure of output, and your allocation of the administration cost is only always going to be somewhat inaccurate. Okay, because it's a very, very difficult cost to actually allocate. So they have taken the easy way out, and they're simply going to use direct manufacturing hours because that gives you a rough measure of what's the total activity in the factory. Okay, so administration costs are always going to be more or less somewhat inaccurately allocated. So once you've come up with all of this data, you're also given the quantity of the allocation base. Right? So the design costs 100 parts square feet were designed in total. Out of those 100 parts square feet, 30 came from the simple lens and 70 came from the complex lens. When it comes to setup hours, 2,000 setup hours in total, 500 came from the simple lens, 1,500 came from the complex lens, and so on and so forth. Okay? Once you are given this data, the exercise of allocation, the logic of allocation works exactly the same as it did for the simple costing. Okay? You simply use the proportions in which the activity was consumed by the simple and the complex lens, and you assign the cost from that cost pool to each of the lenses in the same proportion as the activities were used. Okay? So I'm going to set up all of this data on the board, but you guys can start working on computing the allocations yourself, line by line. Okay, so someone described to me the split up of the total design cost across the simple and the complex lenses. And then I'm going to let you do the rest on your own. Yes, Aisha. Times a total of 100 parts square feet, right? Out of which 30 parts square feet were designed for the simple lenses. So 30 over 100, or 30% of the total design cost is going to be allocated to the simple lens, and the remaining 70% is going to be allocated to the complex lens. And similarly for all the others, the setup costs are going to be allocated in this ratio. Any questions? Again, the actual math of allocation is identical to what it was in simple costing. It's not any different, except that you do it at a much more refined, much more granular level, and you restructure all of your cost pools by the activity. Okay? So I want you all to go ahead and calculate the allocations for each of the 6 costs. Questions? Okay. Any questions, guys? Yes. It will usually have to be provided, or you'll be given some way of estimating what the allocations are. Okay? So the actual logic, the process of allocation, once you're given all the data, remains exactly the same. You see that this is the same logic as for the allocation with the simple costing. So that part of it hasn't changed. The only thing that's changed is the way in which is everything that you do before you get to that point. The way in which you structure and realign your costs into cost pools, and the way in which you figure out your allocation basis. And you see here, now intuitively, this is going to give you a better allocation of your costs than did this, because in this simple costing system, you have so many different types of costs that are lumped together into one single cost pool. It's a kind of a kitchen sink approach, right? That whatever allocation base you pick is going to have a relatively weak cause and effect relationship with the cost that you're trying to allocate, because there are so many dissimilar kinds of costs sitting inside the same cost pool. Whereas here you have many smaller but more focused, more homogeneous cost pool. So you have the ability to pick an allocation base that more tightly reflects the way in which this cost is actually driven. So that gives you a more accurate, tighter, more meaningful allocation of your cost. Okay? So there's one thing in particular that I would like you all to focus on, which is the percentages of the allocation. So the design cost is being split up in the ratio 30% to 70%. The setup cost is being split up in the ratio 25% and 75%. How about the operating cost? What is the ratio in which the operating costs are being split up? 70% and 30%. Thank you. The shipping cost is being split up 50-50. The distribution costs are being split up 67-33. And your administration costs are being split up in the same ratios you had before, 75 to 25. Now, think about the following. When you were doing simple costing, what were the corresponding ratios for each of these cost items when you were doing simple costing? Under the old system, when you had simple costing, what were the ratios in which each of these costs were being split up? Approximately 75% to the simple lenses and 25% to the complex lenses. For which of these pools? For all of the pools, right? So each of those pools was implicitly being split up in the 75% to the simple lenses, 25% to the complex lenses ratio. Except that we wasn't doing it pool by pool, we were putting them all together, but the sum total was being allocated in the 75 to 25 ratio. That means each and every single line of costs that was sitting inside that large pool was also being allocated in the 75 to 25 ratio. Okay, so compare these splits that you have here to the 75%, 25% split, and tell me, under the simple costing system, which of these costs was being the most misallocated? Which of these costs was being the most misallocated? The setup cost seems like the setup and the design are actually quite close to each other, but both the setup costs and the design costs were being significantly inaccurately allocated under the simple costing system. Because as you can see here, the way in which we redefined it, the 30%, approximately 30% of each of these costs go to the simple. The lion's share, 70%, goes to the complex. Whereas under the simple costing system, we had it the exact opposite way. We had 75% of these costs go to the simple lenses and only 25% go to the complex lenses. Why did we end up with that particular proportion under simple costing? Well, we ended up with that proportion under simple costing because we were using the proportion of labor hours that was being expended on each of those lenses to do the allocation there. And the proportion of labor hours is a fine measure, but not necessarily the best way to measure maybe the design activity and the setup activity. Okay, because you could have a product where you spend a relatively small amount of time designing it, but because that product is produced in a high volume, you end up spending a lot of labor hours in making it. But that doesn't necessarily mean that the product should get a lion's share of your design cost, right? And vice versa. You could have a product where, like the complex lens, where you put a lot of effort into designing it, but the product is not produced in significantly high volume, so you end up spending a relatively small time actually making it. If you see here with activity-based costing, we have a relatively tight link between the costs that are in each pool and the way in which we measure the activity that generates the cost in that pool. So we get a more intuitive, more meaningful allocation. Okay? Does anyone have these totals for us that we can use now? If you don't, then you can start calculating. Does anyone have these totals for us from here? The totals. take a minute. Okay, go home and verify these numbers for yourself. Go home and verify these numbers for yourself. Are there any questions about any of these components? Okay, so you add up all of these numbers and you come up with these total overheads allocated. What's striking about these figures compared to the simple costing figures? What did you end up getting with simple costing? You got 1.8 million allocated to the simple lens, and you had 585,000 allocated to the complex lens, right? But here, with activity-based costing, you end up with an almost 1:1 split. It's 1.1 million for the simple lens and almost 1 million for the complex lens, okay? And this is striking because you know you have 4 times as many simple lenses as you did complex lenses. But that means that each complex lens under the activity-based costing approach is consuming almost 4 times as much overhead resources as was each simple lens. Okay, and that's not a difference that came out before. So you take these numbers and you divide them by 60,000 and by 15,000 respectively to come up with the per unit numbers. Okay, and I'm going to tell you what the per unit numbers are. So I would like you to go home and verify them for yourself. Okay, and the per unit overhead allocated to the simple lens comes out to be about $19. And the per unit overhead allocated to the complex lens comes out to be about $64, so about 3 times as much. Okay, so our new total cost estimate, the simple lens and for the complex lens, works out to about $49.98 for the simple lens and $132 for the complex lens. So go ahead and calculate for me, please, what seems to be the actual profit margin that we are making on each type of lens. Because remember, the selling price hasn't changed, right? We're simply going back and taking a closer look at our costing system. So right now, this is still the price at which we are selling both simple and complex lenses. So go ahead and calculate for me what profit we seem to be making in dollars as well as in percentages on the simple and the complex lens. So the profit margin of the simple lens seems to be $13.02, right? Whereas the profit margin on the complex lens seems to be some $4.93. Now take those numbers and scale them by the selling price to tell me the profit margin percentage. So 1302 divided by 63 is approximately 21%, right? And 493 divided by 137 is something very small, less than 5%. 3 points, approximately 3.4%. Okay, so just stare at these numbers for a minute and compare them to what you had under simple costing. Okay, so your unit cost under simple costing was 58 and 75 for the simple, whereas your unit cost for the simple under activity-based costing is only $49.98. So it seemed as though we were making a relatively low profit margin on the simple lens, only about 6.7 cents on the dollar, whereas in reality we are making almost 20 cents on the dollar for every simple lens that we are selling. So it seems like with the simple costing system, the simple lenses were being substantially overcosted, and as a result of the fact that they were being overcosted, they were also being what? Overpriced relative to what might be the fair market value for those lenses. Now the most striking difference is actually for the complex lenses. If you look at that, we looked at that before we characterized our pricing strategy as being a premium pricing strategy, because that's a big profit margin. But in reality it turns out that we are making almost nothing on each complex lens, because it's in fact costing us a little bit more than $132 to make each complex lens if you look at the true value of the resources that the complex lens is taking up. Okay, so when we discussed what we were going to do before we jumped into the example, I told you we're first going to go back and look at the costing system, look at the new information that we get after improving the costing system, and see if that changes our priors a little bit, right? Now that you are armed with this new information, what would you do differently in terms of business decisions? There are many different types of decisions that we can think about. What would you do differently in terms of business decisions? So it seems like now that we have this new information, can we afford to drop the price on the simple lens to 53? Actually, interestingly, we can drop the price to 53, and even if we were to drop the price to 53, we would still make the same profit margin percentage approximately as we thought we were making before, right? So an obvious pricing change for the simple lens. How about for the complex lens? What would you do with respect to pricing the complex lens? Now you have this little bit of feedback from the market. This seems to be a very reasonable price. You have a customer who wants to stay with you, but you realize that you're practically giving it away for free. There's like no profit. The product that you put $132 into making, you should make more than 3.4 cents on the dollar eventually when you sell it, right? So what do you think you can do? You cannot naturally roll out a complete price increase. Price increases do not work the same way as price decreases. But you can test the market a little bit with a small price increase, okay? And what kind of increase you test the market with is going to depend a lot on what you believe the elasticity of the demand for that product is going to be. It looks like, just given the bare minimum of information we have, that the elasticity for the demand is not going to be super high with the complex lens. Okay, because it's a specialized product, it's something that other manufacturers might have difficulty making, and you seem to have a loyal clientele, so you can test the market with a bit of a price increase. So pricing decisions are the first kinds of decisions that you would revisit. Now, there's a second kind of decision which is very important, which is decisions about product mix. Okay, what does product mix mean? You only ever have a certain amount of production capacity. Do you have unlimited production capacity? No. Right? You only have a finite amount of production capacity. And if you have more than one product that you have a demand for, which you know how to make, you have to make the decision of how much of your capacity to devote to one product and how much of your capacity to devote to the other product, right? Or which product to focus on. That's what we call a product mix decision. Now that you have this ABC information, would you go back and revise any of your product mix decisions? Sorry? Specifically how?
You concentrate on the specialized, making more
you might, or it's a little bit difficult. That's one sort of obvious takeaway that comes out of this, but it's a little difficult to see how that will go, because you might decide that ramping up production on the complex lenses might help to generate more economies of scale and bring that cost down more. So it's difficult to tell how that decision will go, but certainly I hope you all agree with me that this analysis is very useful in improving whatever product mix strategy you had in place before. The last thing that you can do better now that you have this ABC information is cost reduction. And this turns out actually to be the biggest reason why ABC is used. Okay, everyone always wants to bring down costs, right? Cost reduction is always a concern in everyone's mind. Now, just looking at this analysis, can you put your finger on what you need to do in order to bring down your costs? It's very difficult because you don't get any texture for what these costs are or where they're coming from. Right? The best thing that somebody can tell you is you have to bring down the total direct labor hours if you want to bring down your overhead costs. But you can't bring down your direct labor hours unless you actually produce less, so that's not a very useful insight. But when you have this activity-based costing analysis set up, you can actually put your finger more directly on what kinds of activities are the most expensive and which activities should I focus on reining in or tightening up if I want to reduce my costs. So somebody could argue, for example, that the design activity is very expensive because each part or each part square foot takes $4,500 to design. So if you wanted to bring down the design costs, one clear way to do that would be to simplify the design of the product and try to eliminate any unnecessary parts. Right? So that way you reduce the amount of time that your design engineer spends in designing, and you actually have a feasible, implementable strategy for bringing down your costs. So try to reduce the number of shipments, or try to combine 2 or more batches into one batch so that you can reduce the number of setup hours. So an ABC analysis actually gives you implementable ways in which you can reduce your costs that the simple costing doesn't give you.